Everyone. Welcome to today's Merk webinar. Our topic today is on investing in yourself. On today's call, we have Merk's President and Chief Investment Officer, Axel Merk. Joining alongside Axel will be Managing Director, Hannah Merk, and myself, Financial Analyst, David Song. At the end of today's presentation, we will have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during the presentation by typing it into the questions box on your screen. Please also note that this presentation will be recorded. Just before we begin, I would like to announce that we have our upcoming quarterly webinar that's right around the corner, so mark your calendars for July 20th. We will be sending out reminders in the coming days. And with that, I will now turn the call over to Axel to begin the presentation. Axel, the floor is now yours.
Thank you, David, and welcome everybody. Our quarterly webinar is, of course, our more product-focused webinar. We'll give you an update on our funds. Today is like most of the other webinars, is a way to get you thinking about investments from a perspective that you usually don't think about them. And it doesn't always have to be about long short currencies, although we might end up talking about that at some point. But it is about figuring out, are you diversified? Are you looking at your portfolio properly? And today we have a very different tack on things that you already heard in the introduction. Our Managing Director, Hannah Merk, who doubles as my wife, will be on the program, and you'll find out in a moment as to why we've invited her to be a special guest. The first thing here is also not your typical chart on the markets. When I was asked the other day, and I mentioned that in the newsletter, what is the best investment advice I can give to somebody who is about to retire? And many of you may be aware that anybody in the industry is really not allowed to give specific investment advice. So we always have to give general answers. But the one specific answer, and the reason for that is because we don't know the specific situation of the hundreds of callers, or in this case, webinar participants that might be calling in, and as such, we can't be too specific about anything. But we can give general rules, and one of them here is get up and go to the gym. So I mentioned that as the answer to the quote-unquote best investment advice that I could give. And the reason here being that the one thing you can control the best, better than buying and selling a security on an exchange, is your personal health. And your personal health is very relevant because the return you can generate on yourself is really far superior, in my view, many times than when you give your money to others. And with that, I'm not just saying giving it to advisor, but even when you buy a company on the New York Stock Exchange, well, you're basically delegating the management of that money, the running of that business to somebody else. And so if you roll up the sleeves and are able to invest in yourself, that's better. And if nothing else, that's a diversifier. So if at old age, you're still physically and importantly mentally fit, you have many more options, and you might be able to stomach a downturn in the markets better than otherwise, aside from the fact that you get to enjoy things. And so back at the end of 2008, when nobody bought any financial products, I started writing this book called Sustainable Wealth, published it in late 2009. This is not supposed to be a pitch for the book. You still find it on the internet, but I don't think I get any royalties of anything that's sold these days. So this isn't a pitch to sell it. But this is kind of in the spirit of the same thing. What you do in a world of debt and consumption, in a volatile world, to sustain yourself. And we'll talk plenty about low interest rates here in a moment. But obviously staying fit physically is one thing. If you look at online reviews of one of the main themes of the book, some said, oh, this book doesn't tell you enough because it's just telling you to spend less than you're making. Well, that's kind of investing and living a sustainable life isn't rocket science. Yes, if you spend less than you're making, you'll be just fine. Most people have their expenses too high. When you might recall back when you were a student, you had few worries, well, partially because maybe your parents took care of things. Nowadays, obviously, many have student loans, but importantly, as you grow older, you tend to pile up all these obligations from mortgages to saving for college to all kinds of other expenses, some of which may not be necessary. And so for most people that run out of money, it is really the expense side, not the revenue side, that is the issue. So I mentioned that as a prelude before I pass it on to Hannah to talk about investing in yourself from a very different perspective. And as you might have recognized when we sent this out, the subtitle is what your advisor doesn't tell you. So already the things I told you now, most advisors don't tell you. I got some emails from advisors, do you really want to send this out? You might want to upset all the advisors. Well, if you read our recent newsletter where we touched on the topic, I don't think advisors will be too turned off because we're not really stepping on their toes too much. What we're really trying to do is to try to broaden the discussion here a little bit. And we have on these calls, we have a mix of advisors and individual investors, family offices listen. And the message here that we have is really geared at the broad audience and of diversification. And I dive into a little bit more as to why these audiences have actually a lot in common. But that said, let me pass it on to Hannah here to talk about investing in yourself from an angle that you might not be used to. Hannah.
Thank you. Thank you. You're passing it on to the master of watching expenses, for sure. So I'll be approaching this topic of investing in yourself from the perspective of really family assets and very specifically investing in the next generation. And the impetus for this is naturally that while we by now are hopefully somewhat financially savvy ourselves, and I'm sure all of our audience as well, the real test is really how we can help the next generation become financially independent as the first step before getting savvy in other ways. And in our case, we are really combining theory with empirical research and practice. We're using our 4 kids ranging in age of 10 to 20, and we're using them as a way to see and test and implement to see if our advice works in practice. And so far, we think it's working. Can I have the next slide? So our goal is to help kids become financially independent. But before starting to talk to them about the stock market or monetary policy, in our case, our dinner discussions, we really first should think about how we and how our kids make decisions and what drives us. And talking about this driving, we are using the idea of a gearbox to list some of the things that are definitely interconnected and they influence the choices and decisions we make, be those investment decisions or career decisions or any other choices. And I'll give a little bit of an idea what I'm talking about. Can I have the next slide? So when you, for example, about life goals, when you're talking with your kids and trying to talk to them about money, the life goal definitely shouldn't be, well, make more money and invest it. The life goal is more something about reaching financial independence. And I think everybody pretty much agrees that if they don't, they have their own goals, but there are many other things in life that are certainly equally or even more important. Happiness is linked to meaningful relationships, intellectual challenges, finding a way to have a meaningful impact professionally. And then just one of those things is the financial independence. But certainly there's research that showed that the lack of financial independence causes unhappiness. So you can look at it from that perspective. Can I have the next, please? So in addition to the goals, you obviously have the education angle. And in many families, I see people are really outsourcing education, looking for the best possible school. And of course, it's important, and it's great to find the best possible school. However, the topics we're talking about today are the topics that really matter. There is no school that teaches any of this. Kids will not learn this from the school. They will learn this from you or from their friends or by watching everybody else. And you really want you to be the person who is driving this. So, and everybody should have, of course, their own educational philosophy, and you should have your list of things that you think is important. And I just threw in here a few things just as a food for thought of what type of education you should be thinking about sharing with your children. And at least in our family, really, again, it's the nightly dinner table. That's where this education happens. That's where we are modeling to our kids the way to think, and question, and be critical, and at the same time respectful. So I see our role either as advisors or as parents in the education to be of huge importance. Can I have the next one, please? And this is, of course, in my opinion, of course, the most important thing. Both of these things, they are really linked to the values that you live by. And hopefully within the family unit, there are shared and common values. But even if not, this is an area where your children will have to develop a sense of what are the core values that they live by, and therefore also later on invest by and do everything else by. And as a parent, you can discuss these things to death if you want to, and you should discuss them, but the kids will be watching how you do it, how you lead by example. Are you showing respect? Are you showing open-mindedness? Are you clear about right and wrong in everything you do? So once you have figured out all of these gears, then the rest is really a piece of cake. Monetary policy is a piece of cake compared to all of this. And really, as a summary, what I think everybody can perhaps agree to is that what we're trying to do is to bring up resilient individuals who will then leverage their talents to improve the lives of others as well as themselves. And that as a premise, what I'd like to share with you, and let's see whether we have the time to do it, probably not in all detail, but I'll share with you kind of a couple of milestones by age in which you can introduce specific topics and discuss them and cover them at a specific age and in your preparation for financial independence. And this is really a 20-year plan. You cannot do it. You shouldn't do it overnight, but obviously if you're starting later on, you catch up as well. So starting at any time is better than not starting. I started really thinking of it as kids as young as age 3. And I think I'm going to, rather than going through each one of these, if anyone wants to have these slides, you're welcome to write it in the question box. I'm happy to send them to you and happy to also explain in much more detail what I mean by each of these topics. But let me take a couple of examples. So first of all, age 3, what is appropriate in terms of financial topics? And this is really this is the famous marshmallow test, which I'm sure many of you are familiar with, which is if you put a kid in a marshmallow in a room with nothing else, and you tell the kid, you can see your marshmallow, you can have it, but if you can wait an hour, I'll give you 2 marshmallows. And research shows, this is a famous case, research shows that those kids who are able to actually wait and just look at that marshmallow for an hour and not eat it, and then as a reward get 2 marshmallows, those kids do remarkably better in life in every aspect than those who did not have the self-discipline to say, hey, waiting is better than instant gratification. So this practicing of delayed gratification as early as age 3, or as early as kids can comprehend it, is important. And a very easy way to do it any time of day is, the child wants a cookie. No, you can't have a cookie now, but you can have one after lunch after you finish your carrots, and so on. The list goes on. But sometimes for us, of course, it's not intuitive because we are used to instant gratification. We want something, we go to Amazon, we order it. But that's not the way that is helpful for a child if you want to make them responsible and financially independent at any point in time. So I would start that as early as possible. Let me pick another one. So let's take age 7. This is the time kids are already in school. Everybody's asking them, do you want to be a firefighter? Do you want to be a president? What do you want to do, an inventor? This is the time when one can already easily talk about the fact that life costs a lot of money, everybody needs to work. Work is good. Work for a living. There's no choice about that. Everybody needs to work. Question is, you have a choice of what you do. And there's a work and there's a reward for that. And obviously different career paths lead to different directions. Everybody will be changing their mind 100 million times. But that's the time when you can start talking about what to do, what you're interested in doing when you grow up. Let's take age 10. We have a 10-year-old now, so we have practiced all of this several times. So truth about credit cards. There's so many people, unfortunately, still in their 20s who are having their first credit card and getting in trouble with that. So at age 10, far before they get their first credit card, this is when we talk about the different cards and what you do and what you don't do with them. And again, that you don't live on credit. Your expenses are always below your income. Can I have the next one? Let's jump ahead. Good, thank you. So it's only at age 13 that is the first actual investment product. By that age, kids have had several years of math. They can understand. They have had, they'll find it exciting. And before that, all of these other topics are really much more about having the right habits. And I would go back to age 12, for example, demonstrating wise purchases. What I mean by that is, first of all, you don't buy anything you don't need. That's point one. And point two is sometimes the cheapest isn't the right thing. Sometimes you look for quality, durability, and so on. And you need to really just take your kids along for everything you do. So you go to Home Depot and you're choosing roofing materials for your next project or redoing the roof. Discuss with them why you would choose one or the other. It may sound mundane, but it's actually very, very real. It's easier for a child to focus on that than to be looking at, well, are you buying a Tesla or a Porsche? Because that's all in la la land. Talk about things that they can and they should be focusing on this age. And then maybe jump ahead to age 17. Explain credit reports. Again, sounds very specific, but there's a reason why you want to talk about this now. Before, at age 18, when they get to college and they get their first credit card, you want to explain how these things are interlinked, why it is important to have a great credit score, and how easily you can mess that up by silly mistakes. So again, you prepare by covering all these topics before they actually specifically then they get that card in hand. At age 18, there's another big decision, which is student loans or no loans, whichever way if you're financing of their college studies. In any case, the young adult at this point has to be part of those discussions. They need to be part of understanding, first of all, how big an investment this is in their future, and whether or not they will have a part in paying that back. And even if they don't, they should have a goal, and you should have a goal with them, which is that at the time when they graduate, that's when they become fully financial independent. Their job is to work and to save and to invest and make the right decisions. And the bank of mom and dad is officially closed. And we have this, this is a test case. We haven't gone to age 25 yet. This is 20, but we have a goal for our kids, and we'll see how it works out. But we also have a goal for them that by age 25 they should be making their first investments in terms of perhaps a rental apartment, buying an income apartment, buying a house, renting out some rooms to other young professionals. But using those first couple of years out of college of really already saving substantially enough to make a big investment of that sort. So not spending it on the fast cars, but rather saving and investing towards something else. So I said no time to go through each one of these, but I'm happy to send the slides over and then also go into much more detail of each age and why we think in this order. And obviously, there's no one size fits all. there are kids who mature faster or slower, and some of these topics maybe you can juggle them around a bit. That's not really the point. The point is to have a list of things to check and cover whenever it works for you, but to make sure that there's a goal and the goal is shared so that the children themselves know that they're expected to be financially independent, and you're helping them to prepare for that. So with that said, I'm going to pass it on back to Axel if you want to comment on anything that you disagree with or you want to add to.
Thank you. No, thank you so much, Hannah. And I'm always glad that I am the last word to have the microphone, so I can really say anything then as a follow-up. Now that said, thanks so much. I think this was very helpful. Different from how we usually cover these things, but I do think it is important. And all of you who grab too many marshmallows too early in your life, you know you're doomed. Probably not. That wasn't really the message here. The message is that this is a long process. And one of the questions that we came up as Hannah prepared this is, well, where do we put into to learn about monetary policy? And we thought, well, do we put it somewhere in parentheses? And I said, no, it deserves its own spot. It's not really something we just mention on the side in parentheses, and that may, of course, just be our household. Some of you who followed me long enough might remember that in 2008, I was with Neil Cavuto on Fox Business, and I complained to him that my, at the time, 10-year-old son knows more about monetary policy than our dear policymakers. So there are always different times when you can introduce different topics, and obviously if you high households where investing is a bigger part of the overall experience, obviously the topic is going to come up more often. And we will, by the way, the slides are obviously not just for the for this particular topic on investing family, but also for the outlook on the markets that I'm about to give you, kind of the more traditional part of our webinars that will be coming in a second. But just to round out this topic, if you want to ask, is there a direct implication of what this means for your investments? The first point here on the slide is really the one that I think is the most direct takeaway. Investing isn't about showing off. And it's pretty sad that one has to write that. But the reason I write that is that a bull market makes many smart people. There's, again, an increasing number of day traders that think they can make their livelihood just day trading with no real experience, but because things always go up, because CNBC might tell them to buy something. And of course, an environment that's been going up year after year after year, that seems particularly easy. A message here a little bit, especially since our audience is mixed, we do have the individual investors that are listening, they might be on their own embracing kind of all the functions that this industry does in various levels, and this industry is changing, as we know how people are changing on mutual funds to ETFs and so forth. But let me just give you a little bit of a different perspective here as well. Financial planners are probably the ones who would most likely talk about how to include the family, but at the same time, unless you have done it yourself, and or you have a lot of experience on also generational planning, it is something that everybody on their own should really think about it. It is noteworthy that in this industry, if you're a professional investment advisor, most professionals cannot retain the next generation. So you build a relationship with somebody who is in their prime years as far as saving is concerned, and then they want to give the money to the children. Most investment professionals are not able to kind of keep the relationship. And I'm not just saying that from a business point of view for advisors who may be on the line, but to me that suggests that not enough is being done by the professional community to actually discuss those sort of topics, because to the extent that professionals gave individuals guidance on these topics, I do think that there would be a far greater retention rate, so to speak. And then conversely, of course, those do-it-yourself investors that are out there, similarly, quite often one forgets some of these things. If one is lucky enough to have built substantial wealth over one's life, quite often the children don't know how to deal with money. And there are all kinds of stories about how it is a curse to actually inherit money and so forth. So all these things It's a lifetime of preparation, and it's not just a lifetime of investing prudently, but also preparing the next generation in doing that. And then obviously we can go on and on. I'd like to keep it at that here for now. Just one more word here as we go through this. It does also mean that when you're an asset allocator or portfolio manager, an asset allocator needs to have been in the trenches as well. And let me just pause here on this particular topic here, and I'll be glad to go into this in more detail if there's any family office on the line or some that want to discuss this in more detail. Please drop us a note. So with that, let me here take this to another level. You don't want to be the folks on the left, basically. It doesn't mean you need to necessarily sell as the guy on the right, but it does mean you want to be independent. You don't want to be going with the crowds. And in order to do that, you do exactly what we think is prudent. You're trying to educate yourself. You're trying to educate yourself from as many angles as possible. And so with that, let me use this cartoon that you've seen almost certainly if you've followed us for a while of Janet Yellen to talk about what we think is happening in the markets and our outlook. As you may have heard, Janet Yellen, or the Federal Reserve in particular, raised interest rates for again in June, and gave this huge speech about how they're going to sell off the balance sheet. And if you follow me on Twitter, we posted a bunch of analyses of what's going to happen to the Fed balance sheet if we want to dive into more depth on the technicals. And we have a lot of internal discussions. One of the discussions we have is every other week we have a discussion with Bill Poole, the former president of the St. Louis Federal Reserve, who's been our long-term senior economic advisor. He just had his 80th birthday, by the way. We are very honored to have him with us. And he's been quite critical of the Fed, but he thought that the announcement that the Fed made was very constructive. I was far more critical, especially if you saw my post on Twitter. But what he said, it binds the Fed really to set them on the course, and if they want to deviate from that, they have some explaining to do. My take was a little bit different. My take was they're promising something that is almost impossible to live up to. And notably, when I listened to the folks at the Fed, and I attended a conference the other day at the Hoover Institute at Stanford, where you had a bunch of active Fed officials and then retired ones, debate of what the appropriate size of the Fed balance sheet was. Well, the short of it is there is absolutely no agreement. And there are a gazillion different reasons of different sizes and here and there. They don't know where they want to be heading to. They don't know where what the parameters even are that they want to look at and so forth. So there are tons of open questions. And so one of the things the Fed has said, we're going to use interest rates as the primary tool and selling off assets as a secondary tool. Now, by the way, the reason why that's all relevant and we get all excited about it is that we think a key reason why asset prices have been rising relentlessly is not just the low interest rates, but also QE, the asset purchases. When you buy bonds, what you do is you compress risk premium. You're causing junk bonds to yield less. You're causing volatility to go down, causing equity prices to go higher. And that's why we have this picture of the pressure cooker as the Federal Reserve tries to go away from that. Volatility might be breaking it back out. Asset prices might be plunging. And because everything in quotes has gone up, you might have everything go down. And that's really why we're so concerned about these markets and why we're preaching that diversification is far more complex than it has been. Now, the Fed has been emboldened by well-behaving markets and says, don't you worry, we'll just do this. And don't look at what we do. Like when we buy bonds, then it's an easing of conditions. But now as we might be selling bonds, don't you worry, that's not a tightening of conditions. And of course, that's a bunch of baloney because if it works one way, it has to work the other way. Part of the reason why the markets are so well-behaved is because the Fed is so slow, and we've argued many times the Fed is behind the curve, which means that on a nominal level, they might not be tightening. Even on a real level, they might not be tightening, even if normally they start raising rates. And so basically, the short of it is that at some point we're going to have a recession again, and the question is, how are they going to do it? Are they going to stop buying things, or will they selling things? Will they continue to sell bonds as they lower rates again. Bill Poole thinks that they will or they should, and knowing Bill, yes, I would agree that they should. I just don't see it happening. And so the credibility of the Fed will be at stake down the road. Now, maybe it's a problem down the road, as some people have pointed out. For the short term, they will likely continue to hike rates, but they've already said they're going to need to hike less because they're selling off bonds. And again, that links the two and doesn't make one independent from the other one. So in the meantime, if you look at the market, this is an image here of the so-called FANG stocks that go up and up and up and up. Except just recently, we had this short but sharp sell-off in tech stocks. And well-trained as everybody is, we buy the dips. And so dips have been bought and things have moved back up a little bit at least. The question again is, and we've asked this question a few times along this rally, is this it? Was this the canary in the coal mine? I happen to think we're getting closer and closer to it. And back to what it means as an investor. You can be an investor that says, all right, I'm going to get it out at the top. Or you can be somebody who is more prudent and takes chips off along the way. And the reason I say it's more prudent, going back to this example of 2008, in late 2008, a lot of folks have said you should double down and buy more. And that is correct if you accumulated cash. Then that is something that I think is worth considering. But if you haven't done that, if you haven't taken chips off the table, that means you had a portfolio that was riskier than you should have had. That means you have lost more money than you should have. You lost money than you should have, and then you should double down and get risky investments. To me, that's reckless, if not criminal, to suggest. And so similarly, if you want to buy the dips, you can do that, but only if you take chips off the table on the way up. And I'm saying you can and cannot do. Of course, it's up to any individual, and this isn't specific investment advice, but it just makes no sense from an asset allocation point of view to always kind of extend. It's like doubling down in the casino. At some point, you're risking more than you should. And obviously right now everybody's, because things have gone up, if you've been buying stocks, you feel fantastic. That does not mean that the standard way of diversifying is gone by the wayside. Part of the problem, of course, is that you don't know what to diversify to, and we'll talk about that here in a little bit more. Let's look at here at recent news and then comment on that a little bit. We showed you this chart last time, and a little update on this one. This shows here the total U.S. oil production and then the rig count. The rig count is mostly the small guys, the fracking guys, and also other rigs that have been built in the U.S. And the reason we show this is oil prices have been coming down. They seem to have stabilized now last day or two, maybe I say. But the relevant part here is that OPEC has been trying to throttle back production in hope that it will raise oil prices. But yet the fracking folks appear to have access to credit again after the kind of the little turmoil they had in early 2016. In our view, the fracking guys will always be the marginal producers. Those are small guys. They don't need that much capital to get going. And so when prices move back up, they'll go back online. And so as OPEC ramps down production, U.S. production is going to make up for the slack. They don't make up for all of the lack of production yet, but they will over time. And that's one of the reasons why it's just very difficult for the price of oil in the short to medium term here to move higher in our point of view. Now, what does it mean for the markets? If we do have an overproduction, a lot of the high yield credit in the U.S. is energy related, obviously not all of it, but then you have the so-called deteriorating financial conditions. And a lot of times people say, oh, there's only a problem in one sector, it can easily spread to other sectors. Now, in early 2016, that happened, and then the right answer was to, quote unquote, buy the dips. That will not always happen. That is, in our view, the exception rather than the rule. When we talk about oil, and especially with in our shop, we like to look at the dollar as well. We've pointed out a number of times that the dollar is not cheap. This is the dollar in relation to a 1 and 2 standard deviation band. There's a longer term moving average here. And the dollar index here, the trade weighted index, is, at least compared to historic levels, still very, very expensive. And one of the things that the dollar has been very sensitive to is being what's happening with our dear administration. So let's talk about the fellow that you may love or you may hate. But the dollar, just to bridge it back to the previous slide, has gone down ever since it rallied in the immediate aftermath of the election. We showed you the slide about how different industries have done between the election and the inauguration, the so-called Trump trades that did well. And here we're using some indices that JP Morgan had created. The exact details aren't all that relevant. I wanted to give you an update here on what has happened since the inauguration and since the last webinar when we showed you this. And it is very notable that the deregulation trades have not worked out. And so basically, as we all know, there's a lot of stuff happening, a lot of information coming out with the administration, but they're not getting a great deal done. And clearly, we now have the Senate that might or might not be passing the healthcare reform. We have somebody who has a no prisoners, take no prisoners approach, and in recent days, his appreciation by his supporters increased just a tad. Part of it was because his lawyers told him to not tweet anymore, and so he tweeted much less, but he just gave a speech again where he ranted about all kinds of issues. Again, his supporters may appreciate that, but the problem with the take no prisoner approach is you don't make many friends. And that might be just fine in some ways, but it's not fine to get things done in Congress, where you do need to build coalitions unless you have a large majority. Theresa May in the UK is just learning that you got to work with others. And so if you don't have that broad support, you have to do the exact same thing that Obama did, that you have to govern through decree or through executive order. And the problem with that is that if you rule with the executive order, the next guy or gal, the person who's going to be president next, is going to be able to undo everything. And as a business, you're not going to make long-term investment decisions because you don't have the certainty of what the rules are going to be like, what taxes is going to be like, and so forth. And so in that sense, we always vote for change, but then we don't get it. And so in that sense, I'm putting Obama and Trump in the same boat. And with that, I hopefully offend everybody here. But the thing is, unless we make the deep structural changes that are necessary to kind of put this country on a different course, and for my pet peeve is sustainability of entitlements, we're going to be trapped in many things. And we already talked about, oh my God, we're cutting so many expenses and so forth. Well, the reason why we're cutting so many expenses is because we don't have the revenue and we've made too many commitments. And unless we change some of those dynamics, which you cannot easily do, we're just tweaking at the fringes. And it doesn't really matter much who's in charge, but the fundamental issues and challenges are not being changed. So I dug up a cartoon from the peak of the Eurozone debt crisis to give an update on Europe here. At the time, I put in the United States of Europe had arrived, and there was about how Europe went about dealing with that. And the reason I show this is just to give you an update on the Eurozone. A couple of things are happening in Europe. We've had a couple of elections. They didn't turn out to be voting for the populist candidate. In France, you now have a so-called newcomer. I say so-called newcomer because Macron is in some ways from the establishment. He just positioned himself, the new president in France, as a newcomer. But he also swept through the parliamentary elections, the assembly elections in France, and has an absolute majority now. We had that in Spain a few years ago. Rajoy in Spain as a prime minister then took years to implement reforms. Spain is doing much better than it has, but could have done so much more. It's going to be very interesting to see what's going to happen in France. France will have to implement a reform. Just about everybody in the political spectrum, except for the extreme left and right, wants to have reform. So we're quite positive it's going to happen. But the French farmers are going to take out their tractors and trucks and going to put blockades on the highway. And it's going to be an interesting thing to watch. But ultimately, we are quite positive on the reform process in France. That doesn't mean everything is going to be great in Europe. Europe is going to have plenty of problems to come. The economy in Germany is going gangbusters, and they have an election in September coming up. It does appear right now that there's going to be not a huge change, that there's a bit of a change in tone in Germany. Merkel, the German chancellor, just talked about potentially introducing a European finance minister. It might have something to do with the passing away of the former chancellor in Germany, Kohl, who is the fellow who brought Germany back together and then also took Europe into the, or Germany in particular, into the euro, and who had pleaded, mostly behind the scenes, that one should be more constructive in dealing with with Southern Europe, and so maybe some of that is moving into a new wave in Europe. So it's going to be very interesting to watch how that's going to unfold. The short of it is, from an investment point of view, we think that the German low yields are not sustainable. I just talked about the US, how I happen to think that the selling of bonds is going to create headwinds. A different way of looking at that is that I think we're closer to the end of the hiking cycle in the US. Few people are saying that right now. In contrast, in the Eurozone, I think we're closer to the beginning of the hiking cycle. If you translate that to currencies, the euro that everybody loves to hate might be performing much, much better than expected, because the yield differential is going to shrink. That's our, or my forecast, at least for the time being. Might change our view on that. And of course, some of this is priced in, but we happen to think that process is going to continue. So and by the way, to the extent that the Federal Reserve is selling bonds, all these bonds globally are linked quite a bit. That's also why one of the reasons US yields continue to be low, because the ECB and the Bank of Japan continues to buy. And so if the US is going to sell bonds, and if bond yields are going to rise, they're going to rise probably globally. I happen to think that, relatively speaking, the European yields are going to go up more than the US yields. And in fact, I wouldn't be surprised if US yields are not going to move up because of the headwinds, but European yields just might. An update on China. China has been quiet. Part of that is due to capital controls. Part of that is because of minute management of many parameters. We just recently had overnight lending rates in Hong Kong for the Chinese currency skyrocket. That happens periodically when the Chinese government wants to whack speculators that bet on a falling renminbi. So it's by all means not market forces that play out. We did have an announcement just yesterday, it was, that MSCI is adding China, the A shares, to its emerging market index. To just put that into context, MSCI provides indices that many institutions follow in their global asset allocation. The A shares, that's the onshore shares, they're going to be added with 0.5% weighting. So it's really mostly just symbolic. The symbolism matters. At least overnight, the Chinese shares were up. That said, that doesn't fix the Chinese problems, that they have not done the sort of reforms they need to do. They cannot, in our view, continue just pump money into infrastructure spending. They need to allow small and medium-sized enterprises to thrive. In order to do that, they need to facilitate the credit allocation better. We think they've missed the boat on that. They've created huge distortions. In early 2016, when China had a hiccup, at least China was blamed for the correction we had in the markets. That issue has not gone away, even if on the surface everything looks kind of very, very calm. Couldn't have a webinar without giving an update on gold. Got a lot of questions on that always, and here we sometimes mention gold has had an annual return since 1970 of close to 8%. Then people ask me, well, where do you get that from? Well, we get that from the price of gold. If you just do the math, you come up with an annualized return close to 8%. And either that means gold is hopelessly overpriced, or it means the greenback is not the strong dollar that one might think it is. And I happen to think it is more the latter than anything else. The gold obviously doesn't pay a dividend. There's a cost of carrying, of storing gold. And but at the same time, gold hasn't changed. Gold hasn't changed in millennia, has never changed. The thing that's changing is the dollar, and the price of the dollar is obviously changing as well. One of the reasons we bring it up is we've called it the easiest diversifier, not always the best diversifier because it sometimes moves in tandem with the markets. And as a diversifier from a correlation point of view, here we use the monthly correlations. There is no correlation. The problem people always have, why should gold perform well going forward? Because, hey, we got rising interest rates. Well, I don't see how in a decade from now we can have positive real rates unless we get serious entitlement reform done. And if you look at the healthcare bill in both in the House and the Senate, those don't get us on a sustainable path. You want to have infrastructure spending. We want to have this and that. We want to ramp up military spending. How are we going to do that? How are we going to live up to our promises to retirees? And in my view, mathematically, that's impossible. And so what you have to do is you either have to cut back the benefits. That is extremely difficult. You can default, and that is a form of a default. And you can, of course, how do I default on the bonds? That doesn't need to happen because we can, quote unquote, print our money. And I happen to think that is the path of least resistance. If you look around the globe, different countries around the world have different mechanisms. The Eurozone has tried it with austerity, and just structurally, it's always more difficult to spend money in Europe. But as we've also seen, we got a fellow who does, quote unquote, whatever it takes to get things rolling. So when push comes to shove, central banks will probably print the money, and that means the thing that doesn't change might appreciate relative to the thing that does change, which is the currency. Not just with the dollar, but with other currencies as well. And so I happen to think the Fed will remain behind the curve. And so if you put that in the context of rising risk premia in an environment where asset prices in general are expensive, when risk premia rise, that means volatility rises. That means you have to discount future cash flows more. That means businesses and return streams, including those from fixed income instruments, that get discounted will get discounted a higher number, meaning valuation of anything that has a cash flow is going to get lower, whereas the price of gold that doesn't have a cash flow is much less, if at all, affected by that. So from that point of view, so if you think that volatility is going to rise, gold relative to other assets, just based on kind of economic theory, the way we understand it, should appreciate. Of course, there's no guarantee that if we have a correction, the price of gold will go up. But if you look at the bear market since 1970, with the exception of the bear market in the early 80s, where real interest rates were moved to the stratosphere, price of gold did very well in those days. It's one of the reasons, it's a key reason why we say, hey, look at gold as a diversifier. If you go beyond that, and we've said this many times, you've got to look at more complex things, long-short currencies, as we do, long-short equities, and so forth. These are all possibilities. One of the challenges with long-short equities and long-short anything really is that you can be wrong on both sides. It's one of the reasons why I mentioned earlier that, hey, what about betting on taking a position on the yield spread between the US and Europe? You can do that. And there you do it on the fixed income side. And so similarly, that might generate a return stream that's uncorrelated. Now, depending on what you do, it may still be correlated to something. Not everything long short is uncorrelated, but you got to look beyond the traditional investment portfolio. And we had a newsletter the other day on on a endowment model to investing. Part of the reason we talk about more of these things is because investing in a traditional stock portfolio and diversifying to bonds, when bonds then mean investing in the high yielding investments, doesn't give investors the sort of diversification that they have historically been looking for. With that, and this cartoon, I think this is still one of the better ones we've ever come up with, because it's just so telling that and investors are still not prepared for this. I'll pass it here to David to manage the the Q&A. And before I pass it back, let me just mention once more, thanks to Hannah for having given the introduction from a very different perspective. If you want to have a copy of the slides, let us know. And also, as before you go, because some people leave when we go to the Q&A, if there's a topic you want us to cover, this is the opportunity. Submit it. You can use a Q&A box, submit it on the website. And similarly, of course, if you want us to look at your portfolio more specifically, we don't have a separate accounts business for small investors, but we are willing and able to help in various ways, institutional or family office or other very large investors. So you may, of course, submit any queries you have, and maybe you have a special situation in portfolio that's worth discussing in a webinar. Not that we're going to talk about you then personally, but feel free to challenge us. Anyway, David, if you want to manage the Q&A.
Great, thanks, Axel. Again, I would just like to remind everyone that you can still ask a question by typing it into your text box. And our first question comes from Larry White, and he asks, what impact will the Fed's reduction in its balance sheet have on the economy? Isn't that monetary tightening the same as raising interest rates? We are already in a slowing economy, so what would likely happen? Axel?
Yeah, thank you. So I touched on that a little bit, and by all means, the selling off should be a tightening. Janet Yellen tried to tell us during her press conference that the sell-off in the balance sheet is akin to watching paint dry, and that's simply not true. And unfortunately, I didn't put any of the slides here in the webinar. Go back in my Twitter feed to when the FOMC meeting happened. We posted a bunch of images of how the Fed balance sheet is likely to evolve. We don't know the specifics yet. We think the Fed is going to start selling in September, based on the communication that we have seen. It's going to take them years to get the balance sheet down, but they will be selling a good 50 billion a month. And the European Central Bank is telling us they're buying 80 billion. Granted, those are euros, not dollars. They're buying $80 billion a year a month. They're saying that's substantial easing, and the Fed wants to tell us that selling 50 billion is not tightening. Of course it's tightening, and they want to just give the image that this is a sideshow, but it isn't. It will have a real impact. Now the question is, hey, aren't bond yields going to rise? Well, not necessarily, actually, because of specifically of what the person who asked the question is referring to. As the selling of bonds by the Fed is a headwind to economic growth, well, what should happen if we have a headwind to economic growth? Then we should have lower yields, rising bond prices. And so that is the only reason why you don't see the bond market here falling out of bed, because they're slowing the economy. Now, usually what you want to have is you probably don't want to have that. Now, obviously, they have a mess on their hand, which I call this big balance sheet, and so they want to get out of it. But by all means, this is a form of tightening. They think that the market is ready, and the market is ready until it is not. Right now, the market has given them a free pass to pursue it, and they're emboldened by it. But let the markets have a fit, and even if the Fed tells you they're not going to react to when the market is selling off, well, as soon as you have the so-called deteriorating financial conditions, which can happen if you have a bigger mess in the oil market, for example, they're going to back off from what they do. And so it's going to be very, very interesting to watch it, especially since they haven't specified how exactly they're going to be selling the securities. But it appears they're on autopilot for now, and in my view, they can cause a lot of damage, which to me increases the urgency to stress test one's portfolio. Back to you, David.
Okay, our next question comes from David Bakken, and he asks, will the financial problems of U.S. states be a big problem for the U.S. government soon? Axel?
Say it again. What will be a big problem?
Will the financial problems of U.S. states be a big problem for the U.S. government soon? Axel? The
U.S. states. All right. Yeah, that's an excellent question, and there is no easy answer to that. We see what happens in Puerto Rico, and ultimately, I mean, obviously, Puerto Rico is not a fully fledged state, but as they have financial trouble, they are coming up with this board that's suddenly able to kind of change the rules of the bonds and so forth. States cannot declare bankruptcy, so there is no such process, but clearly they can run out of money. And one of the things to monitor more on a municipal level as well is we see retailers running in trouble. Well, a lot of sales tax is generated. That's good for the local community, but it's also good for the state. There's a lot of shifts are happening, and the biggest problem states have is retirement obligations. When you hire somebody to work for the state, and if they get a pension, which most state workers do under various parameters, you have a long-term obligation, and that crowds out other spending. The reason you got potholes is because we're financing a firefighter's retirement. I'm not suggesting that the firefighter doesn't deserve his or her retirement money, but it strangles those states. And ultimately, yes, states have a taxing power. And the question then is, well, is the federal government at some point going to bail them out or not? The problem really is that if not everybody along the food chain is healthy, it impedes investment. Right? A state let's take Illinois, they cannot invest in their own infrastructure, and that then again is going to make it more difficult for other investments to take place. So yes, these are all headwinds. How that's all going to play out, it's difficult to say. Under the current administration, I don't think they at least provide the perception they're not going to provide a bailout. But it's one of these things that when push comes to shove, if they're important enough, then they'll get a bailout. If it's a small state, no. If it's a big state, more likely. And so those are all sort of challenges that will impact the financial health. And then when it comes to trading, it's really important to look at the sort of bond that one buys and where the cracks in the system might be. In the state of California, where we are, for example, there's quite some seniority on many of the revenue bonds and other things on state general obligation bonds and so forth. And so depending on what the legal small print is, odds are as a bondholder one might get paid. But yes, those will be interesting dynamics. On the federal level, we got the printing press. But in Europe, if you just look there, you can kind of make the comparison that the individual countries in Europe are kind of like the states. And when push comes to shove, yes, there may well be a bailout, even if it's one that's backwards. And obviously, the U.S. is going to have a very different dynamics. But needless to say, there will be some interesting times ahead. Back to you.
Okay, and our last question comes from Andrew Herrera, and he asks, would like to get your thoughts on having a strategic allocation to currency and what percentage of a portfolio you would recommend. Axel?
Well, thank you. That's a softball question. And obviously everybody is different. I had in the past, 2 or 3 years ago, I was quoted, if you don't have at least 20% allocated to alternatives, you're not fully diversified. I think I was wrong at the time. I think you have to be substantially more in alternatives. And it doesn't necessarily have to be currencies, but what it shouldn't be in that other hot investment that some salesperson is trying to shove down your throat. It's not the MLP investment necessarily. It's not this or that investment. It is the investment that is likely going to generate uncorrelated returns. The problem with that is, of course, that most of these have underperformed the S&P. What we have done has underperformed the S&P. Our goal is not to outperform the S&P, and that shouldn't be anybody's benchmark. The benchmark should be anyone's personal risk tolerance. And if you cannot, and the other question is not what do you want to make a year? No, how much in a downdraft can I accept every year? And for that, you don't look at the current volatility. You look at the historic volatility, and you put it into context that when that is suppressed, it might be significantly higher. And so the nice thing about a long-short currency strategy is that the currency space itself, the risk profile is often more contained. And so from that point of view, I am very comfortable with having a substantial portion of my portfolio allocated with a currency strategy. Now, that doesn't mean everybody else should necessarily be, because they might not be as comfortable with it. They don't do it day in, day out, and you need to trust somebody else if you can't do it yourself. But if you take the simpler way of investing in currencies, namely having just a basket of currencies, that was popular when the dollar was declining, and until the end of last year, the dollar was rising for a couple of years. That became less popular. What that is, though, you're investing in equities by having not in equities, you're investing in international fixed income securities, cash types of instruments treasury securities and the like. The advantage of that is you are shielded from the equity risk and you have minimal interest and credit risk. To me, that is something that should be very attractive to investors. I happen to think that the dollar versus the euro in particular, but with other currencies as well, might be declining in the years to come. And so from that point of view, even a simple directional currency investment might be a good diversifier. The exact percentages, unfortunately, I can't say. If you reach out to me via our website or on the direct box, we can maybe look at your portfolio and then give you a little bit more specific information. With that, back to you.
Great, thanks, Axel. And that concludes the Q&A portion of the call. If we were not able to get to your question today, we will get back to you via email. So should you have any additional questions or comments, please use the Contact Us section of the website at www.merkinvestments.com. As always, feel free to reach out to James at any time, and he'll be more than happy to help you with any questions. Also, for future webinars, if there is a topic that you're particularly interested in and would like to cover, like for us to cover, please let us know through the comments box. This concludes our call. Thank you and have a great day.